Welcome to another episode of TPA Today. I'm your host, Joey Belsanti, recording from the clubhouse at the offices of 12 Points Academy. Today we're diving into a really critical topic about how young professionals can set themselves up for financial success. To help us unpack this, I'm thrilled to be joined by Greg Phillips, the Director of Financial Wellness and Employee Education at 12 Points. Greg, thank you for being here.
Absolutely, Joey. Thank you for having me. Excited about this. I'll probably be down the hall in my office doing something less exciting. So, again, thanks for setting this up.
Glad to have you in here. This topic really resonates with so many college students and young professionals who are trying to navigate the transition from college to the real world, to the workforce, or really just in their early stages of their career. And building a strong financial foundation is key for their long-term success, not only financially, but really what they want to accomplish in their lives. So we can dive in, and I'd love to start with the big picture.
Yep.
So could you explain a little bit about why it is so important for young professionals and college students to begin planning for their financial futures early on?
Absolutely. I mean, I think, when you're young and in that position, the world is your oyster. You have time on your side, which is so crucial when it comes to things like investing and financial planning. So the better the foundation and habits, frankly, that you can develop early on, it's going to lead to enormous success over the long run. So definitely very important to start thinking about these things, as early as, even before you're done college, right? Start learning more, educate, talk about these things. As you know, there's some stats you share with 12 Points Academy. 88% of adults feel unprepared to handle finances after high school. It's no shock, right? Like, we're not taught these things in high school or even college for that matter. So we're really on our own in this financial journey when we come out into the real world. So again, I think being proactive, starting to have those conversations, talk to your friends, talk to your colleagues, talk to your family. I think it can do wonders.
And I agree. A lot of people feel like they're alone in this, even though there's so much information out there. And a lot of college kids and young professionals, they may be getting pulled in a lot of different directions, whether it be with Robinhood or different brokerage services. Feels like more gambling these days than actually investing. Whether crypto or that's really the new wave right now with crypto. What do you think is like the first step that a young professional or college student could take in really beginning this journey and planning for their financial future?
Absolutely. Get off DraftKings and avoid get-rich-quick schemes. All jokes aside, sort of. But I would say a couple things. You definitely want to start formulating a budget for yourself. Very painful exercise. Most people don't enjoy going through that. But that's really going to drive everything. It's so important. You need to understand where your dollars are going and what purpose they're serving yourself now and your future self, right? We call it give every dollar a job, and that's a really important component to understand. You don't really want substantial funds just building up in your checking account. It makes you feel good. It's kind of fun to look at, but at the end of the day, those dollars are doing nothing for you. Again, you want an envelope going to savings, an envelope going to paying off debt, an envelope going to investing in your freedoms in the future. So again, getting your money to work for you, and the only way to do that is really to have that clear and defined budget. Everything in financial planning, the world tries to make it pretty complex, but it boils down to what do you have left over at the end of each month? What's your free cash flow? And where does your next best dollar serve you? Really hard to answer those questions if you don't have a budget. And then the other thing would be, as you're coming out to the professional world and your career, starting to open financial accounts and understand those different financial accounts and what purpose they're kind of serving, again, for now and for the future, which I think we're going to talk a little more about. Yeah,
definitely. If we want to expand on that a little bit, there's a couple real main accounts that people talk about. What are the most essential ones that a young professional should have? I would think most college kids and young professionals have the basic checking account, maybe a savings account. Not a lot of people that I come across really have heard about a high yield savings account or even a CD. What do you think are the most critical accounts to have open, and also some accounts that will allow you to put your money to work in the best ways?
Absolutely. So like you said, checking account, most people are going to have that. That's self-explanatory. But like I said a moment ago, that's not really a beneficial account. That should just be money coming in, money coming out to different places, right? Next would be a savings account. You bring up a great point. I'm even talking to people in late stages of their career, or even people almost retiring, that don't have their money in a high yield savings account. It's just sitting in a traditional savings account in their bank. giving them very minimal interest. So you want to make sure your cash, your reserves, are in something high yielding. There's a lot of great accounts out there. They sound too good to be true, but it's not. Right now, again, depending on when this is released, times may change, but you should be getting about 4% on your cash at no risk, no downside, no liquidity restraints there when you need to take it. And that makes a huge difference, especially as you're building up your cash base. So the high yield and the savings account is super important. Really, that's what I call step one in the order of operations of your financial life. You want to have that emergency savings. Typically recommended to be about 6 months of expenses. You can go more or less depending on how conservative a person you are. But that emergency savings, that foundation, that prevents you from trouble in the future. High interest credit card debt, maybe dipping into retirement accounts that we're going to talk about early. That's really your base. That's really step one. Before you get too crazy about, again, all the things you see online or invest, as great as like investing and retirement and building wealth, as much as I love all that stuff, you really need that cash basis behind you. But good news is you're still going to be earning something on that if you're in one of those high yield savings accounts. So yeah, checking, savings, credit cards. So sometimes those get a bad reputation. If you're using them responsibly, they're actually a great tool. Number one, again, in terms of building your financial foundation coming out of school, you want to start building credit because you're likely going to want to buy a home someday, or maybe start a business or things like that you're going to need credit for. Credit cards are fantastic to build up that credit as long as you're using them responsibly, paying them off at the end of each month, not overspending on those balances and letting them, keep growing into eternity. The other thing with credit cards too is find one that works for you and that you're getting points back on. That's actually really important. Again, when you're spending money on your debit card and your checking account, doing nothing for you. Again, as long as you're not overspending and letting that debt build up and you're paying it off, that credit card is actually giving you something back. So again, it's all about giving your dollars a purpose, and you can do that really well with a credit card.
Another thing with credit cards that I recently found out is that they are a good way to protect your finances as well, with the certain things that credit card companies offer for the like theft protection and stuff like that, where it's not your money, it's the credit card, it's the company's money. And I don't know, another perk, I guess, along with the rewards and stuff like that. And actually, we're going to have another 12 Points professional on, I think, next week, Andrew McGill, talking specifically about credit cards.
Oh, my buddy Andrew.
Yeah. And it's a big problem, over $1 trillion of credit card debt. So we'll dive into that more in depth next week. But you mentioned a couple of the accounts, checking, savings, high yields. Where do IRAs or retirement accounts fall into this?
Yeah, absolutely. And to that question too, just at a high level, every account is really earmarked for different time horizons, right? Like which of these accounts that we're talking about that you're directing money into, it's very important to understand your time horizon on these different buckets. So again, high yield savings and checking is short-term and emergency savings. So if you have goals 3 to 5 years away, typically you really just want that in cash, not subject to risk and not subject to any liquidity restraints. From there, when we're talking about IRAs or 401ks you may have at your first employer, or if you have an employer now and you have one, that's of course long-term money. You're not to really touch that money in the IRAs till the age of 59 and a half. But with that, the trade-off is you're getting great tax advantages by utilizing those IRAs or 401ks. So with a IRA, we can talk about traditional and Roth. If you're doing a traditional IRA, that money you're putting into the plan is tax deductible. So you're lowering your gross income, you're paying less tax in the present. The other huge benefit once the money's in the IRA or the 401k is what we call tax deferred growth. So every year as your investments are paying you dividends, capital gains, growth, appreciation, maybe you sell a position and get a massive gain, you're not paying tax on any of those gains coming in year over year, which is, it takes a huge compounding effect over 10, 20, 30 years. Whereas when you're invested outside in something like a brokerage account, which we can talk about, you don't get that advantage. So, but again, IRAs, you got to understand that's kind of not to be touched till age 59 and a half. There's ways to, but you will be taxed and penalized. So that's really your long-term bucket. And then there's Roth IRAs. So we talked about traditional, nice benefit now, paying less tax. But with traditional, you do pay tax on the way out when you use the money in retirement. Roth is the complete opposite. Roth is an after-tax contribution to that Roth IRA. So no nice benefit in the present, hurts your wallet a little bit more now, but the benefit to that is it grows for the next 10, 20, 30, 40 years. You never pay tax on it when you use it on any of that growth or the original contributions. So that's the difference between traditional and Roth IRA. Okay.
And the typical college student or maybe even young professional would hear retirement account and specifically maybe an IRA and think to themselves, I'm young, I have a lot of time until retirement. Why should I start now and sacrifice part of my income to go towards those accounts now rather than thinking about this later? Why is it important, you think, for young professionals to consider saving for retirement currently?
Absolutely. That's a great question, one I often get. And really it boils down to the power of compounding. You know, the eighth wonder of the world. It's remarkable. When you have this time on your side early on in your career and in your life for that money to grow and compound on itself, it is a tremendous effect. So I know most people have probably heard that. Start as early as you can. Start as early as you can. I mean, we have a lot of other financial responsibilities too, so I get it. It's hard to think about retirement when maybe you're trying to save for a home or pay off your student loans. You got to find that balance, but it really is true. The more you can get in there now, the better. The other thing I encourage younger people to think about with that question is, yes, retirement is far away, but contributing as much as you can now will open up flexibility for you even before retirement. You know, coming out of college, maybe you're still living at home, you have less financial responsibility, maybe you can afford to get a little more in these retirement accounts. In 10 years, you might have a mortgage, a family, more financial responsibility, and you're probably going to be able to maybe not contribute to your retirement plan at all because you've already built this base that's going to continue to grow and compound for you. So don't think about retirement accounts only for retirement, but think about it as flexibility in those in-between years as well.
That's an interesting point there. And for young professionals who are have a job that maybe the company offers a 401k, how do you think they should take advantage of that? And kind of in the same way of thinking about, contributing to an IRA, I'm young, what's the point? But there's some special benefits with the 401k, especially the match, the company match. Right. Could you talk a little bit about that and why it's important for young professionals to take advantage of that as early on as they can?
Absolutely, yeah. So, like you said, if your employer offers a match, which again, as you're going through job searches and getting offers, it is definitely an important factor to look at. Making sure the benefits are good where you're going. Because again, people on track for retirement that had a match versus those that didn't have a match, you know, there's stats on that. So the employer can really help you in your long-term financial plan and your retirement planning. So definitely an important factor to look at when accepting a job. But let's say, you do have a match at your employer. Great. Want to do your best to take advantage of that at all times. You know, maybe emergency fund is still step one, making sure you have that base of 6 months of expenses outside of things like 401k. But once that's checked off the list, you got to be hitting that match at least before you really think about any other financial priorities. That's free money being offered to you every pay period. It's going to make a huge difference in the long run. You know, from there, let's say your match is, goes up to 4%. So if you put in 4, your employer gives you 4, you're at 8% total savings rate. What the data shows us is we need to be saving about 10 to 15% of income towards retirement accounts in order to someday successfully retire. Pretty high and scary sounding number. Doesn't mean we'll all be able to do that today or at all times, but something to benchmark yourself on and strive towards. But if you're at least getting the match, maybe then you direct your priorities back to something else, depending on your situation. Maybe it's student loans. Maybe you don't quite have your emergency fund and you need to save a little more in that high yield savings account. But again, you got to hit the match. It's a no-brainer.
It's doubling your percent right there.
Exactly, yeah, exactly. So, maybe if you have massive credit card debt, that would be something before the match, just because, credit card debt is usually 20% plus at least. But, when you're weighing like student loan payments or getting the match in your 401k, I think it usually, depending on your situation, makes sense to get that match first.
So really the theme of what I'm hearing is saving early on, saving now as a young professional and maybe even as a college student really allows you more freedom in the future, for your future, if you start saving now instead of having to really kind of recoup what you didn't. Play catch up. Yes. And a lot of this has to do with kind of habits and mentality surrounding your money and kind of how you approach it and really savings. How do you think one could build kind of this mentality of save now? So kind of it's really sacrificing now to prosper more in the future and have more freedom in the future. How do you think someone can kind of build that mentality in the present?
Yeah, that's a great question, and I'm sure it's definitely hard for some of us. I'll be honest, I wasn't a great saver until I really ramped up my career and had a 401k, which again, I think that's a big part of it is automation. Try to automate your finances as much as possible. Direct deposits to your emergency fund, direct deposits to your 401k coming out of your paycheck. We know how life goes. We have a million other things going on. As important as we know finances are, sometimes we try to ignore them and put them on the back burner because they are stressful. When things are automated, you'll be shocked on how much easier that makes your life and how much better off you'll be, because it's not like you need to go into one account at the end of each month and remember to say, all right, I'm going to move this amount to this account for my future self, because we know how that goes. It never happens. So automation can be your friend. Another thing I would say is, when we make more as a society, we spend more. It's natural human emotion and an instinct. Try to limit that if you can. Really focus on it. Think about it. What we call lifestyle inflation. So as you're making more, try not to keep that spending out the window on that same pace, and keep directing more to those retirement plans, emergency savings, and I think you'll be in a good spot.
I saw something where, especially with 401ks, you talk about automation, so you can automate a contribution, correct? And also, as your pay increases, you can also increase your contribution automatically. Is that something that you can put in place?
Correct, yeah. So that's a great time to bump up those contributions. If you get a pay bump and you bump up your contribution 1 or 2%, you're still going to have more money in your wallet, but you're also saving, much more too into the 401k. So that's always a great opportunity to bump up those rates. And also, maybe when you lose some other payment, maybe you finish paying off a car or paying off your student loans, now you have more free cash flow. Another good opportunity to bump up those retirement plan savings rates.
Okay. So there's a few things I just want to touch on before we have to wrap up here. One of them is student loans. You've mentioned that a few times over the course of this conversation. And over $2 trillion in student loan debt in the U.S. is becoming a bigger and bigger issue as students and parents have to sacrifice to fund education, and the cost of education is rising and rising and rising. I think here at 12 Points, we predict within the next 5 to 10 years, parents would have to put away $110,000 to fund their children's education, which is astronomical. It's scary. It's scary. For a young professional, a recent college graduate who has college debt, student loan debt, how should they approach that debt and really balance paying off the debt with saving for their future?
Totally, and that's a very common question. I always hear, I have massive student loan debts, I can't even think about saving for retirement, which could be true for your situation, but there's definitely some things you want to consider around that. First, you really want to understand your loans. Are they federal? Are they private? What are the interest rates and payoff terms on these loans? Super important to know what's going on with them. From there, you can think about things or look at things like consolidation or automating your payments or refinancing for lower rates. One thing I do like to point out is the federal loans have a lot more perks than the private. So don't be too eager to possibly convert to a private loan just for 0.5% or 1% lower rate, because you might lose out on some opportunities with those federal loans. I know we've heard about forgiveness in the past. It went away. Could always come back. If you're in a private loan, you're not going to get any of that treatment. So those federal loans do have their perks. But great question on balancing that debt repayment versus savings or investing. What we look at when it comes to that question is the interest rate on the debt. So if you have debt, I like to use the number 6.5%. It's a pretty conservative estimate. I like to be pretty conservative with these numbers. 6.5% is a number you could use for the historical market returns of a balanced portfolio. Again, some people might say it's 8.5 or 9, depending on what data you're looking at or how you're invested, but let's call it 6.5%. If you have debt below 6.5%, it usually does not make sense to forfeit your, IRA contributions or your 401k contributions or your investment contributions to speed up the repayment of that debt. Because there's a spread there. If your interest on the debt is 4%, but you'd be getting 6.5% in the investments, that's a 2.5% spread that you're missing out on. So as much as it's a mental thing too, which I get with debt, some people just want to rapidly pay it off as quick as possible and be done. I totally understand that. And that's important to consider too, your kind of mental mindset. But if you look at the numbers and the data, the best decision would to pay the minimums on that and put that other cash flow towards investing for the future.
Interesting. So it's not just how fast can I repay it. There's some strategy that goes into it too.
Totally.
Nice.
Totally.
There's a study that came out a few months ago where not only are students and recent graduates suffering because of student debt, but also parents, and this doesn't really have to apply to young professionals, but I think it's just interesting in this conversation, where parents are sacrificing their retirement savings, putting away for retirement to fund their children's education, and it's setting them behind the 8 ball in terms of when they can retire and really their plans for the end of their lives. How do you think really the decision of what can you afford for college, how does that come into play with taking on debt for school, parents sacrificing their savings? How should parents and students really approach going into school? What can they afford? And maybe this applies to grad school as well for young professionals. What's that conversation like? How should children and parents be having that conversation?
Yeah, it's a tricky one, right? Because it's a major problem in terms of parents sacrificing themselves too far to pay for college, but at the same time, I can't shame anybody for wanting to provide for their children, right? And that's what people are trying to do. But I really caution people, and again, it is a conversation, I'd say, like you mentioned, between the student, the child, and the parents on what makes sense for both of us in the long term for our family. Because overextending yourself in your future retirement to pay for that college debt, people joke around, but it's true. Then your children might just end up taking care of you in retirement because you didn't have enough funds, right? So I would say, for parents, they need to make sure I mentioned that 10 to 15% savings rate for retirement. If they're able to hit that at least, and have some of their other boxes checked off, like emergency savings and things like that, any extra cash flow, then that's fine. You can put it towards that college tuition. But if you're not hitting those numbers, you really need to be careful about overfunding that college tuition.
Interesting. And as the cost of education continues to rise, there's going to be even more of a discussion going forward. So to wrap up, I want to discuss some of the consequences of not saving for retirement. And you work a lot with participants of 12 Points Retirement Advisors 401k plans, and you have many discussions with them as you educate them on some of this stuff. What do you see as some of the potential consequences as you interact with employees of these companies? What are some of the consequences of not planning early enough and not saving early enough? I imagine that it gives you less freedom later in your life, and you probably have had many conversations with people about this. So what have you seen from your experiences with this?
Yeah. I mean, less freedom and more stress, frankly, unfortunately. I do talk to people frequently that, maybe they're in their early 50s, late 50s, and they didn't start early. And, they come to me and say, I want to meet with you just, because it's a resource and, see any advice you have for me. But I know I'm probably not going to be able to retire comfortably, and I'm probably going to be working much past 65. So that's the type of things that happen, unfortunately. And I think what leads to that, again, is good habits early on, educating yourself early on, avoiding things like high interest debt, avoiding not having that emergency fund. Because again, I also talk to people that they were doing a great job with their 401k. Maybe they had, $100,000, $150,000, but something major came up in their lives and they didn't have any form of emergency fund. they liquidated their entire 401k and they're back at square one at 40 years old, and now they're going to really be playing catch up in a tough position. So I think it's setting that foundation like we talked about earlier. Good habits, emergency fund, build your credit, avoid that high interest debt. Once you have those things squared away, now you can really focus on funding that 401k or IRA or retirement to a larger degree.
Awesome. Well, I think that's a great place to wrap up there. Greg, thank you so much for joining us.
No, this is awesome, Joey. Everything you're doing is awesome. You got a cool office in here. So, yeah, thanks for having me.
Thank you so much, and we'll have to have you on again sometime
I'd love
soon.
that. Yeah, that'd be great.
Awesome. Well,
All
thanks
right,
again,
thank
Greg.
you, my friend. Yep, take care.